What if I told you you could predict the future? For today's guest, this is certainly the case when it comes to market events. Charles Nenner is the founder of Charles Nenner Research, and using a unique system of cycle analysis and pattern recognition, Charles and his team can accurately predict moves in any asset class. Charles's unique system doesn't involve a crystal ball, but instead, it's all about learning from patterns that we see in history across hundreds of years. Because for Charles, it doesn't matter that markets change or that indicators might become more or less relevant depending on the age that we live in, or indeed that we trade very differently to how our grandparents' generation did, because ultimately market cycles happen no matter what. Charles argues that you don't need to know why some things happen, you just need to know that it is going to happen. And that perhaps sounds a little bit like chicken and egg, but stick with us, as this really isn't an interview that you want to miss. If you're fed up with market commentators explaining market moves that have already happened or justifying why their predictions haven't come to pass, then this is the interview for you. Charles gives us some great predictions on where inflation, interest rates, and the stock markets will go from here, and where we are in the current cycle, which according to him could last between 30 and 35 years. If you enjoy this interview, be sure to share it, to tweet it, and to hit the like button. And if you haven't already, why not subscribe to GoldCore TV? Because this is one of the many conversations that I've had with market-leading commentators, and they all bring some serious value to how we think about the economy and investments. With this in mind, I'm delighted to welcome Charles Nenner to GoldCore TV. Charles Nenner, welcome to GoldCore TV.
Great to be with you.
It's a pleasure to have you on. Now, your expertise is in global and market cycles. Now, there's no doubt that we're at an inflection point in global developments and financial markets at this moment in time. And one cycle in particular is the inflationary cycle. And we've got inflation running hot all over the globe. Now, unlike a lot of commentators, you believe that this is just the start of this inflationary cycle. What's led you to this conclusion, and how long do you think it's going to last, and how bad do you actually think it's going to get?
Well, first of all, I always like commentators to show how they get to the result and never say anything. They just have an opinion. So we calculate exactly with our programs what's going to happen, and we show how we get to that point. So first of all, the inflection point was already June, July last year. If you look what the insiders did, then you see that's where the inflection point was. And I had been writing that the people who were strong enough to buy at 209 at the low now are selling. And the small investor didn't know something at 209 because he was afraid, and he doesn't know why the insiders are selling. Things don't move at random. So we built, I built many years ago an algorithm that tells you exactly what's going to happen, because it's the law of nature, the law of the universe. And there is a longer term cycle, about between 30, 35 years of inflation and interest rates that has been working for the last 300 years. So we can assume that it continues. And that cycle bottomed, which means we're getting much higher interest rates and we're going to get much higher inflation. Now, you can come up with a story like if the stock market goes down and General Motors go down, then they have a story why General Motors goes down, and when IBM goes down, they have a story why IBM goes down. But it just go down because the cycle is down and the stock market has to go down. So all these commentators have all kinds of stories why we see inflation, but that's just a short-term opinion based on nothing, because they don't know where the long term is. And it gets as far as even Yellen, the Treasury Secretary, had no clue. She said in Congress, and the only thing she said is, I hope it's not going to get too bad. People live like doing analysis like 100 years ago.
And how long do we actually think that this cycle is going to last?
30 years.
30 years.
30 years. We're up in a new cycle. Very short term. We do short-term cycles and long-term cycles. Short term, the inflation is not going much higher for a couple of months, and then it's going to take off again. So for people who are not on your age, I just want them to know what happened to inflation, interest rates, that interest rates went up as high as 18% in the 1980s.
Indeed.
Before they came down. And they really have to study a little bit history in order to know what to expect.
And so we're going to have a little bit of a tapering inflation short term, but then it's going to take off again. Now we're at about, if we take the US CPI just as a benchmark in terms of official inflation figures, we won't talk about what the underlying real inflation figures are, but we're at 8.6% was the last print on that inflation. How high do you think that it's going to get when it takes off?
Well, I had a first target of 12.5%, and then after that 20%.
Wow.
And after that, I have to see what's going to happen.
Okay. Now, none of this happens in a vacuum, as in inflation doesn't just go up in a vacuum. There have been a number of things that have contributed to this, one of them particular being central bank money printing around the world. But what is apart from say that just the pure cycles that we see, what's the underlying inflationary pressures that's going to see us seeing inflation at a high elevated levels for the next 30 years?
You see, I leave it up to the pundits, because I think all those reasons don't make any sense, because if inflation has to take off, something has to happen. So then we're problems with the money supply and by the debt of the United States, but that's not why it takes off. It takes off because it's time for inflation to take off. And then people do certain things and certain mistakes are being made. And it was like, oh, that's why it happens. So to our work, it's not interesting. We're there to say what's going to happen, when it's going to happen. And we're not so much interested why it's going to happen, because we're not sure if those reasons are really the reasons why things happen. Because if those are the reasons, then I couldn't say that for the next 30 years inflation goes up, then it might go down next year.
Okay, so the cycle is for much higher inflation.
Right.
The cycle is for, it's going to last longer, up to 30 years. And these are just generally cycles that the markets go through, that we go through as human beings. We can look back when it happens and say that it was caused by X, Y, or Z, but the reality is X, Y, or Z just happened during that inflationary cycle, and correlation is not necessarily causation. Is that the?
Let me give you an example in the stock market, if I may.
Sure.
If you take the year that ends with a 7, and you start in the 1800s, we don't go back that much, but let's say go backwards. Then you see in 2007, the crisis started, the market came down. If you go before that, the end that ended with a 7 is 1997, 98. Maybe remember there was a big downturn in markets. There was a crisis. If that before that is 87, everybody knows what happened in 87. Before that, there was a big down movement in 77, 67, 57. So it's very interesting. You can ask me, why does it happen with the 7? And then we say, you better be out when the year ends with the 7, because we don't know what's going to trigger it, but that's not our business. It doesn't help you to become rich by knowing why it happens afterwards. It just happens when the year ends with a 7. It's a big problem.
And we can we extrapolate from that then, if we're going to see inflationary cycles for an extended period of time, that necessarily what we're going to see is much higher interest rates as well for an extended period of time,
right? Which
will have further consequences for financial markets and geopolitical developments as well.
They should have. They should have. If you look over, if you do an overlay over the last market crashes, 1929. 1957, 1973, 87, 2007. For now, it looks like it's a very serious situation, even more serious than in those down moves. Because if you see how much percentage was lost in the first 4 or 5 months in the stock market, it hasn't happened for the last 100 years.
So very serious in what regard? Are we talking about a stock? Extended bear market in stocks as well then?
Right, but the problem for people who haven't seen the real bear market is that, of course, you can have a bounce of 25-30% up, and then all the people that on the media will say, well, we saw the low, and the people who are not insiders start buying, and the insiders start selling again, and then it goes lower and lower, and that's usually why it doesn't end well for the for the more amateur investor. Because he didn't check history, how much of a bounce is normal within a bear market.
Now we're seeing some interesting developments at the moment. We are seeing stocks, and again, if we look at the US stock markets just as our benchmark, look at the Dow and the Nasdaq, they're plumbing their lows again. We have started this new cycle then. from whether you call it November of last year or January of this year. We've started a new bear market cycle. Is that your take on it?
Well, we said that by the middle of June, you have one more chance to get out of stocks. If you didn't, we were in zero stocks from December last year. We're still in zero stocks. And people who were not in zero stocks because they get no subscribers, we told them better be out by the middle of June. And we have price targets that can give you on the S&P of 3,709, and on the NASDAQ of 11,180.
Right.
So the work that we do is it will give you the exact price target and also the day that is going to be reached there. And don't ask me why. Something probably is not going to happen. And then all the media says, oh, but the Biden says this or the Fed said that, and that's why the market went up. And I leave it up to your philosophy if that's really the reason. I'm not so sure, but it's not important for us.
And so middle of June, we're there now. So you're saying this is it. This is the last time to get out of stocks before we actually see a significant, what can we call it, correction? I can't even call it a correction, a significant bear market from here on in.
Well, no, when our target is 3709. That's another 100 points down, I think, from this morning on S&P. And then we probably get another bounce. So then maybe we should wait for the next bounce. If you watch our research, you can know exactly where to go out and where to go in. As you know, maybe you don't know, people get 30 days for free so they can check it out. And it's a very volatile time. And maybe it's helpful just to see how insiders approach markets, not by stories that they hear in the media, because the media always wrong. I happened to write Sunday about, because sometimes we had questions, whoever understands markets will never say the markets look bad, the economy is going down, because then it's fulfilling prophecy. So they continue to say everything is fine until they can't say it anymore, and then it's too late for people who invest based on the news. And
if we do see this extended inflation, and we'll have an opportunity potentially to get out of stocks on the next bounce higher, but a prolonged bear market potentially after that. In terms of stocks, and if we were to take the Dow just again as our measure, how bad do you think it could get long term for the Dow?
I think it first will go to 15,000.
15.
And then even have a target of 5,000.
Wow. Okay. So 15,000, that's kind of half where we are basically now. We're hovering just over 30,000 at the moment. So we've got a 50% minimum target on the Dow based purely on historical cycles.
Right.
Wow. Okay.
It seems far-fetched, but in the year 2000, when I was still at Goldman Sachs, I said the Nasdaq goes down 80,000, and I was invited by the White House to do some research for them. And when I say down 80%, they disregarded it. They didn't think that was possible, but it went down 80%.
There's a lot going on in a world where we see the Dow heading to 15,000 or even 5,000. Not least among them, there's probably going to be a much greater wealth gap in an economy where we're seeing massive inflation and also an exit out of financial assets.
I wrote some about research I did, how countries come to an end after an expansion. And usually it is when there's a big gap in income, there's a big debt problem, there's weak leadership, there is internal struggle, and it usually ends in a war. And the United States is having almost all the symptoms of what's happening. And what's also interesting is that most cultures have an upswing of 250 years. And actually it started in the United States around 1750. So the 250 years are over. So you can also take long-term view what's going to happen. And then in the East, it's exactly the other way around. It's like countries like India, Singapore, China, Australia. That's where it's all going to happen.
Right. So this is very much end of empire type stuff.
Well, the funny thing is that most people don't know that when Rome was burning, the Senate was discussing of angels were male or female. No, you can read it in the books.
Yes, yeah,
now
yes.
We're discussing, maybe you follow it, what the woman is. What's the definition of a woman. So it seems to be, correlate. It comes back. Everything in history repeats itself.
History repeats itself, and I suppose that's the basis upon which these cycles are formed.
Yeah.
So, and this the concept of a war as the end of empire situation, is that internal unrest within the United States? Because we're seeing an awful lot of disquiet, and we're seeing a much a widening of the left-right gap in the US in particular. And these things never bode well for a peaceful society. So how do you think that potentially unfolds?
I think it's going to be a very bad situation, especially if we would see that Trump comes back. I might have a civil war, but it looks like now the leadership is concentrating on outside wars, because I'm watching a lot of United States, and whenever they come up with questions, why is the inflation? Why is it like that? Then all Biden says it's because of Ukraine. So he's using the war in order to excuse himself why there's inflation and why there's high oil prices and why there's high gas prices. And usually societies are going under. They find an outside enemy to blame it on.
So I mean, there is very much an effort to establish this narrative of Putin's price hike. There was a speech given by Biden there towards the end of the last week, and I listened to it. It was only about 8 minutes long, but within those 8 minutes, he used the term Putin's price hike about 3 times. So anybody that's being following this channel and following financial markets in general, you may or may not agree with this, but is keenly aware of the inflationary pressures that had been appearing way before the invasion of Ukraine, and also the inflationary pressures caused in the COVID era by excessive central bank money printing. But now we've got the White House and we've got Biden, who are trying to rewrite history and establish a narrative. Do you believe this is to put the attention externally and to create the external bogeyman? Not to suggest that Putin is not a genuine bogeyman, but to put the attention on an external bogeyman rather than the internal.
We have no idea who's running the business. I mean, like Treasury Secretary Yellen said 4 weeks ago, 5 weeks ago in Congress, that it's only short-lived inflation. And now last week she says, I made a mistake. It's not short-lived. Doesn't she have any clue what's going on? Maybe we should look at our cycles, which they have no long-term view. They have no, I don't know who's governing the government. It's definitely not Biden, because there was a very interesting observation by the person who speaks for him when he was asked, does Biden go to Ukraine? And then she says, we will not let Biden go to Ukraine. So the question was, who's we? And we still don't know who's we, but I don't think he's in charge. Who's
running the show?
Who's running the show?
We've got a situation that has been exacerbated by the war in Ukraine, as well as other fundamental factors domestically in the US and internationally, and that is an energy crisis that we've been going through and are going through. We've got oil at the moment is just around $120 a barrel. Natural gas in the US is at about $8.60, 70, something like that. Natural gas in Europe, where we are, is significantly higher than that. Where are we in the cycle when it comes to energy prices?
The interesting thing is when crude was around 63, we went long and we had an upside price target of 122. Okay. And we took profit because 122 was reached. So the question is, had it something to do with Ukraine? Of course, something had to happen in order to get it to 122, but it had to go to 122 anyway. Could have been the OPEC, would not have been the OPEC. So again, you don't know. If you're there in order to make a nice profit, you should concentrate on what is going to happen and not why it's going to happen. But since most people don't know what's going to happen, they concentrate on why it's going to happen. So that's the whole situation.
So where do you think oil is going to get to, or natural gas prices? Where are we in the cycle?
Natural gas prices, we had a high of 9.60. So we went out. We have been long, I think, from 2.5. We see some weakness, and then it can go back just below 10 again.
Right. Okay.
And the target of crude oil, if it gets next time about 22 is 140.
140. Oh, okay. And we've seen a number of other people. I think we've seen Goldman Sachs call for and JP Morgan's call for oil a lot higher than that as well, 140, 150 plus. So there does seem to be this consensus that this cycle is not over by any stretch of the imagination just yet. Higher energy prices, higher inflation, higher interest rates. Where does gold and silver fit into all of this mix then in terms of cycles with all of that as a backdrop?
Well, first I want to make something clear that 50% of bull markets in gold and silver happened in a deflationary period. Because the rumor seems to be that if there's inflation, they go up, but they also go up in deflation. Again, cycles are down till after the summer. It's just in the trading range. The bull market is going to continue, but it's just will take a couple of more months. And I don't know if it's ready, but I thought it will be like July, August. I have to look it up. And something probably is going to happen. And then we say, oh, that's why gold starts going up. But we already know now when gold is going up and from what level it's going up. So again, it's for the people who follow us. Why would you watch whatever the reason is? Because it might not be the reason.
Okay. So again, bull market in gold and silver. What do the cycles suggest in terms of a price target then for these metals?
Well, first of all, cycles are up to until 20,000, 2027. And our first price target on gold is 2,500.
Okay. Okay. And that cycle is up to 2027, which again,
so probably we'll get much about 2,500. Let's say the first price target is 2,500.
Okay.
And since it's up for 5 years, I guess it goes much higher. If they would decide to go back to the gold standard, if they would go back to the gold standard today because they have no solution, then the price will be around 45,000 already.
Wow. Okay. Okay. And that's based on that 45,000 price target is based on saying all the gold held in reserves in order to back the US dollars in circulation would have to be at about $45,000 an ounce. So it's not just some sort of number picked out of the air. There's a kind of a...
No, you can calculate it, but let's stay normal and say 2,500. And then if it reaches in a year, then there's a couple of years left to get much higher price targets.
And that 2027 date that you're picking out then coincides with your year ending in 7.
No, that the year 7 is only for stocks.
Okay.
It just happened to be that the cycle is up into 2027.
Gotcha. But in 2027, you would expect to see another movement in stocks in that year.
Right. You can write it down, whatever happens. If you go short in 2027, by the end of the year, you make a lot of money.
Definitely be writing that one down. In terms of wider cycles or bigger cycles that have a more global impact, geopolitically, what do you see as being on the cards from a cycle point of view? Well,
as you know, there are 2 cycles I work with also for government. So the first cycle is of internal strife, which is a 60-year cycle. So, you know, I was there in the 60s, a lot was going on, and now 60 years later, and a lot is going on again because it's a 60-year cycle. Now you come with all kinds of conclusions. They used to say it's because people live around 60 years and then they forget what happened 60 years ago. But these days, people live longer, so I don't know if it's a valid point. But then you have the war cycles, and I did war cycles going back to 3,000 years before the Jesus was born. And it started with the Mandarin Empire, and it picks up small wars and big wars. And the small wars weren't even there. The Second World War actually was there, which was actually an extension of the First World War. The Napoleon War was there. The Habsburg War was there. And maybe it's interesting for you to see, if you go to Google and you Google, because it's only one of the cycles, major wars by the beginning of the century, then you see always in a second decade of a new century, it starts to be very difficult and wars are being prepared and they break out. So you can go down 1,000 years, the year 600, 700, 1800. So again, how do we know that? I don't know. What's better that you know it. The same thing happened with the corona. If you take a cycle of 100 years, then you go back to 1918, which had the Spanish flu. Then you go to 1818, which had, I think, cholera. Then you go to 1770, which had typhus. You go down to 16, and it's the exact cycle of 100 years. Now, you have to think out of the box, because everybody's in his box and tries to figure out what's going on now. But if you know a pandemia always starts every 100 years, maybe it's interesting to know and to be prepared. Now, can you do something about it? No. Can you do something that is a winter followed by summer and a winter? No, but you can buy a winter coat if you know it.
Mm-hmm.
So you can't change the cycle, but you can be prepared.
Okay. So in terms of the war cycles, you're suggesting then, or your cycles are suggesting that things may deteriorate even further with respect to the geopolitical situation
especially
that we find
next year.
ourselves.
There's another cycle that moves up. So I think it's going to be quiet this year, but next year could be very dangerous.
Okay. So, and then from a currency point of view, one of the things that always coincides with an end of empire situation is a change in the dominant currency.
Right.
So are we going to be seeing a situation then that coincides with these large market cycles that you're identifying, where we're seeing a rebalancing globally when it comes to currency dominance, and in particular in this instance, the US dollar dominance?
Yes, but usually when these empires go down, it takes 1 or 2 years until they get in trouble. If you look at what happened to the Dutch, they were an empire in 1600s, 1700s, the British after that, then the Americans after that, and there's a pattern. It doesn't change immediately.
Right.
So of course it's going to be the end of the dollar, but not for the next 2 years.
Okay. Okay. So to summarize that, what we're seeing is we're going to have a bounce potentially in stocks for the next little while, but the next move is going to be another significant leg downward. We've got upward pressure on energy prices still to come. Inflation is at the beginning of a 30-year cycle where we're going to see elevated inflation, although for the next number of months, again, we're going to see it maybe tapering off a bit. Geopolitical tension is going to increase over the next 12 to 24 months. And against this, it's not surprising then that there's a cycle for precious metals that's going to go significantly higher between now, not necessarily now, starting in the next couple of months, and 2027.
Yeah, because we have investors that they cannot wait. And as you see, we know all this stuff, but they still don't start really moving. They're in a trading range, and people are trying to find the lows and the highs, and they get stopped out. And we just stand aside until cycles bottom. And I don't ask me why. Then suddenly there will be a realization in a couple of months that, oh, now we have to be long gold and silver and gold stocks. Maybe we talk in a couple of months and then we figure out what the news item was that suddenly turned the metals into bullish, but it's too early. And if you follow the research, then you know exactly when a cycle low is there, and we don't know what's going to happen. We'll see later.
Well, I'd definitely like to do that. We'll definitely catch up with you again in a few months' time. But just before we wrap up here, maybe you can tell our viewers where they can find out more about what it is that you do, and also that 30-day free trial.
Yeah, if you go to charlesnenner.com, that's Nenner, there is a free trial for 30 days. It includes intraday. So it's very interesting. If you look at intraday, you can see something like gold is up for the next 4 hours until this level, and then it's down for the next 3 hours to this level. So that's for short-term traders, because it's based on the same cycles, just very short-term hourly cycles.
Okay.
And you get it for free 30 days. We update 4 times a week and intraday in between. And the easiest thing is just write down what we say and see the next days if it happened or didn't happen. And then it's interesting to see what the media will say, why it happened. Biden said something, the OPEC said something, and then you ain't no better, has nothing to do with it. But of course, something has to happen in order for the markets to move. But it's not the real reason, because it had to happen anyway. I give you one last reason. When the OPEC was very important 15 years ago, and they came together in the weekends to decide what they're going to do with the oil price, I always knew what the decision would be, because I knew on Monday where the oil price would be.
Mm-hmm.
So I knew if they're going to produce more or less, because I know what the result's going to be. Question, did they have free choice or not?
Mm-hmm.
So there's much more going on, because if they had free choice, I could predict it. And since I predicted what the no free choice was, then it's not important if they come together, because it's not important what they decide. So there's a whole philosophy behind it. It looks totally different on how the world functions than if you listen to the average media, where markets go up and down.
It's definitely a different perspective to what to the way that we're used to looking at things. It's fascinating. And what I'm going to do is I'm going to put a link to your website in the show notes in the description below this video. And I highly encourage anybody that's interested to click on that. Take advantage of the 30-day free trial so you can really experience Charles's work. But for now, Charles Nenner, thank you for joining us on GoldCore TV today.
You're welcome. We'll do it again when gold starts rallying.
Indeed, we will. I look forward to it. Many thanks to Charles for joining us today. It's an absolute pleasure when you get to have a conversation with someone who gets you to think differently about something. And what a great thing it is to realize that there are set cycles in place. And so there's almost a template for how to manage your money. Of course, we might not know exactly how much or how little markets are going to rise and fall, but we do know that they will go up and down. And as Charles says, roughly when this will happen. And with cycles lasting up to 35 years, it's a good opportunity to get long-term assets such as gold and silver, which have historically protected portfolios from such cycles. Thank you for joining us today, and we'll see you next time on GoldCore TV. And don't forget to hit the subscribe button and be sure not to miss any of our conversations with market-leading experts, commentators, and investors.